Chasing unicorns has become a favorite pastime of many owners and many company founders. But what is a unicorn anyway? A unicorn is a company that reaches a $1 billion valuation. And as somebody who has worked in a unicorn company, who has been through the whole journey from Series A to Series B, Series C, Series D, and the $1 billion valuation, I've seen a lot of this upfront and firsthand. My job was to build the sales infrastructure, to build the processes, the trainings, the commission models, and basically create a system that works across 20 markets on 4 continents and 8 currencies, and with almost 800 sales agents and leaders across all markets. The unicorn era, as we want to call it, has been marked by low interest rates in the 2020s, so when COVID started. And the central banks basically slashed interest rates, capital was more freely available, so investors jumped on startups, on scale-ups. Back then you saw tech adoption overnight. What was supposed to be a timeline of 10 years until people would go into online education or would do all of their shopping online, crypto, whatever, you name it. It all happened within a span of a couple of months. So there was a massive market opportunity back then. There was a massive opportunity in this convergence of low interest rates, of tech adoption, to use this strategic window of time and pump as much money into potential winners, into potential future superstar companies, and make them grow, make them successful, and be part of that journey from an investor's perspective. Now, it also created, of course, with so much supply of funding, it also created, of course, competition among investors who could invest in the promising companies first. So due diligence was typically dropped. Founders could choose who they wanted to take investments from. Sometimes founders were given advice as sharing their childhood stories and fundraise a couple of $1 million or more based on their passion and based on how the company founding actually played into their personality or what they experienced when they were in high school. Now, needless to say, that this time created a certain bubble. It created very high expectations, and companies that did not make it to unicorn status, that didn't get to the 1 billion valuation, of course, were not seen as successful. Now, what is really important to also keep in mind, in 2022, we had a complete reversal of fortunes. Inflation hit hard. Consumer confidence and preferences shifted. So you had conflicts, including in Europe, that actually hit on consumer sentiments. So budgets were tightening all across the board. Enterprise buyers were scrutinizing, are these expenses that I actually have still worth it? Is this software as a service SaaS solution actually bringing me any values? CFOs, chief financial officers, started to look into the tool stack, like why are we using 80 different tools when the company, or where we're paying for them, when the company actually is only using 5 of them? Let's cancel the contracts of the 75 others. Now, this created a world in which 2022, a lot of companies that built their models on growth at all costs and continuous market growth experienced a reckoning. Suddenly, their existing contracts would be in question, and of course, new customer acquisition was even more in question. B2C companies were also particularly hit hard by this. What do you think the consequence of that was? Suddenly, those companies who have been fundraising to basically cover for a lack of proper unit economics and profit margins, who could not financially sustain themselves and their salaries, right, and their operating costs. Now, they counted on bridge rounds. They counted on investors who would keep pumping money into those companies to keep the show running. Now, in 2022, that changed. Investors were not anymore impressed by childhood stories, but they started to actually look into unit economics, into efficiency, into LTV CAC, lifetime value versus cost of customer acquisition. They started looking into the EBITDA, into what is actually happening in the company, what's the governance like, what's the top talent retention looking like. and they start actually looking back into the business fundamentals. For companies who played the unicorn game, they created a massive problem. And the consequences are well known, with mass layoffs across the board, with reputational harm as well to those companies. And we get to this in a moment. Also, the unicorn status for those companies who achieved it started to become more like a trap or like a weight around their shoulder than actually something that would propel them forward anymore. Now, let's go a bit into how unicorn valuation or how valuations in general work. Valuations are, in a nutshell, an agreement, a private agreement between private individuals or private organizations, between a company and an investment fund, a VC fund typically, to say, okay, I value your company at such and such amount of dollars. That's the worth of your company if somebody were to buy it. And that is, we now make an agreement. How do we define how much that company is worth? We can say you're making, let's say, $5 million in ARR, an annual recurring revenue, or you make 50 million. And now based on this, I apply a multiple. So I say the multiple is 10 times because you have a revenue top line growth of 5 million, right? Now your company with a 10x multiplier is worth 50 million. That means that's also potentially your future value, right? That's a hypothetical value. And it could be that the market shifts. It could be that in 3 years from now, your market collapses, your industry collapses due to new technologies, whatever it is, right? New competitors coming in. And then suddenly it's not worth 50 million anymore. But as an investor, I mean, I may or may not care about that. It really depends on how I design my liquidation preferences and how I design my agreement with the founder, because that determines when I cash out. So I'm not always necessarily vested in the future success of that company. Evaluation is always a snapshot. It's a snapshot of a status quo in the present, and then there's a hypothesis being made about the future potential of this company. And as we already established, between 2020 and 2022, those estimations, those assessments were typically not going through the due diligence that you would expect from today's world and also the world pre-pandemic. Now, to go back into what actually counts and what matters. If your business model, or if your company strategy is built around getting bridge round after bridge round and having investors pumping more and more money into your company, then how would you design your day-to-day operations? What type of people are you hiring? What is your company strategy? What's your market strategy? You would inevitably, and in most cases, end up with a situation where you would obviously prioritize the optics for the investors. But investor optics are not always, and in very few cases, compatible with business fundamentals. You have to see that many founders and companies compare themselves with other founders and companies. X company in our industry is making 200 million in sales. We are only making 20 million. Are we failing? Right? Y company just managed to get a $1 billion valuation. Why did we not? So there's also an element of, and it goes back to one of the core tenets of Strategic X, how a founder's or the organizational leader's worldview and beliefs really play into their decisions. There's also an element of really human decision making, of human cognitive bias that is involved in pursuing and chasing certain valuations or certain goals for the company. And if you now look at a company that's building its model around getting bridge round after bridge round or funding round after funding round, then obviously that would look like, in practice, aggressive market share expansion, go into as many markets as possible, top line growth, sell as much as you can, show that you can get market share, that you can even snatch it away from your competitors. That would mean heavy investments in sales and marketing, even if inefficient. And unit economics, like gross margins, profit margins, contribution margins, LTV, CAC, lifetime value, cost of customer acquisition, and all of those metrics, they do not matter as much in the moment. They can be dealt with later on. And it leads to a situation where, of course, a business operates extremely unsustainably. And in the same way as it is trying to impress investors who see the growth story and who want to see the aggressive growth, who want to see ambition, who want to see the drive, who want to be part of the winning team, at the same time, the company erodes its very fundamentals and its very foundations. And 2022 has been that moment of reckoning where all of that came to play out. It also does not help if respectable individuals like Sam Altman push new narratives around a one-person, 1 billion company. Because the very goal of a 1 billion company is not necessarily good for its founders, for its owner, or even, well, definitely not for its employees. Let me explain why. With every funding round that a company goes through, and in order to get a 1 billion valuation, you need to get investors on board. Who is going to give you that valuation? It's not being done by some rating agency, objectively. No, it's done by people that you get on board, by investors who invest into your company. And so with each of those, you lose agency, you lose autonomy, you lose sovereignty. The more investors you get on board, the more your own shares, your own slice of the cake diminishes. And typically, it is that late-stage investors, because they pay a higher price, or they basically invest at a higher rate, they have preferable liquidation preferences, so their upside is always secured. So whatever happens, they will be paid out first. And that means for early-stage investors and for founders, and especially for employees who are taking sweat equity, we will get to this in a moment, they'll basically be left with nothing. They're left holding the bag. And so the problem with these valuations is that the way that the whole game is designed is that ultimately only a few amount of people will cash out, and sometimes it is also the founders and early stage investors that will make agreements with new investors where they will sell their personal shares. So even if there is no IPO, like going public, going on the stock exchange, even though there's no acquisition, so that means there's no buyer who buys the company at the valuation. Let's go back to our example before. Let's say it's 50 million, but very modest in the framework of talking about unicorns, but just as an example. If nobody buys it for that price, then there is no liquidity. A unicorn status, right, is not a desirable outcome. It's not a payday. It doesn't mean that you get $1 billion on your bank account. It doesn't mean anything, really. It is a marketing ploy. And if you treat it as such, if you say a unicorn status is something I intentionally use as a tactic, then it can be super powerful. Imagine, as a unicorn, you have all the right press, you have worldwide outlets talk about you. Enterprise and government entities typically sign or prefer to sign contracts with market leaders. You get probably preferred access to certain potential clients, and you can sign deals. Doors will open for you that were closed before. You can attract top talent, right? Like somebody who comes from a big brand company, and they probably don't want to join our 50 million valuation based on 5 million annual recurring revenue company, but they want to join the unicorn. That's prestige, that's status, that looks good, right? And on the other hand, you can also push competitors out of the market and completely demoralize and discourage them. Because if they see that you made the unicorn status, they probably don't even want to try anymore, trying to take market share away from you. And so it can play it can be a tactical plot. It can be a tactic that can be very effective if it is used intentionally. And it also, to some extent, made sense during 2020 to 2022, because it was a window where, with a lot of capital, you could get a lot of market share in a very aggressive manner. And then, you figure out the unit economics afterwards. But in the meantime, you push most of your competitors out of the market. You have the customers in your database. You can work with them. You can upsell them. You can do retention, renewals, and so forth. And obviously that can be very tactically brilliant. The problem though is the moment founders or company owners or top management start believing their own theater, they start believing their own deceptions, and they start believing the unicorn story as something real. And when the unicorn becomes an end game, when the unicorn status becomes a strategy, becomes a goal to pursue, then we go again back into the entire malpractices of prioritizing investor optics on very fragile or negative cash flow, very fragile unit economics, and basically an unprofitable business. And keep one thing in mind: what is the way a business can go bust, or like what is the criteria for a business to go out of business? It's the moment it cannot pay its liabilities anymore. It's the moment it cannot pay its obligations anymore. And that is the office rent, that is the furniture, that is the laptops, the fancy whiteboards, it's the company cars, it is the salaries of the employees, the tools that you're using, anything that basically is an expense in your company. The moment you cannot pay that anymore, the moment you struggle to make your payments, is the moment when you default, which means you're basically becoming bankrupt. And so if you run your business in a manner where you're not profitable, where you're not financially sustainable, and you hope for investors to hop in and finance you, and then that investor dependency breaks away because of shifts in the macro environment, then what do you think would be the inevitable destiny of your company, of your organization? And we've seen it all with mass layoffs and so forth, right? And also how companies experience incredible down rounds as well. More about this in a moment. So you see, the problem is with the 1 billion valuation, as you're now valued at 1 billion, who's gonna buy you at 1 billion? Like this 1 billion is a theoretical value until the moment that somebody buys, like a strategic acquirer, a private equity firm, somebody says, I want to buy this company, I want to own this asset. That's the moment when you get your payday. And of course, depending on your liquidation preferences, but that's the moment that you get your payday, is when somebody is willing to buy the company at $1 billion. Now, if you build your company without any business fundamentals, without any unit economics, complete messy setup that is not transferable to new owners, where everything depends on the founder to be involved, then what do you think will happen? Any buyer will say, I'm not interested. There are some fringe cases, right? You think of the acquisitions of, there were unicorns, but you think of fringe cases where companies buy other companies despite really poor business fundamentals, or not really mature business fundamentals. You think of the acquisitions of WhatsApp. Think of the acquisition of YouTube, for example, and others. Right? YouTube had lawsuits going on. Like, it was not in any way a super well-run company, and yet it was acquired. Yet it was bought because of its strategic position in the market. It was the top player in video. It was very strategically positioned. And so, of course, there are fringe scenarios in which, despite doing everything wrong, you can still, of course, be bought at a very high valuation. But again, with a unicorn with 1 billion, or in some cases like WeWork, I think it was 56, 57 billion valuation, who's going to buy this company? And now what happens if nobody buys it at that price? The unicorn valuation becomes a trap. It becomes a golden cage, because you can now not sell the company. So that means there's no liquidation, there's no payday, except, of course, for founders making their personal agreements with new investors and selling their personal shares, something that they typically are not required to disclose to their employees, who took sweat equity and still wait for their payday, which will never come. And then you face the next problem, which is down rounds. So if a new investor would come in, that investor would estimate again the value of the company. Now that 2020 and 2021 are over, most certainly that valuation will be lower. And so suddenly the company is not worth $1 billion anymore on paper, but the investor may say, oh, actually it's only worth 500 million. Now with that down round, you face a couple of additional challenges. There's, of course, reputational harm, right? Because it shows these clients that you acquired, we talked before about government enterprise, or maybe that was not the right decision. Maybe you should look for a more credible partner, right? It demoralizes the workforce. It demoralizes top talent who might want to jump ship, who might start looking around and say, how come? And what happened here? Right? There is also a fracture of trust, right, between leaders and between employees and leaders, the top management and their own leaders, mid-level managers, and their executive team. So there's a lot of fallout that actually happens when the unicorn valuation proves itself not to be real or not to be sustainable. And one piece about this is also, we talked before about how top talent joins unicorn companies because of everybody wants to be part of the winning team, right? And also our investors push for unicorn valuations because they also want to show I have winners in my portfolio, right? So everybody is chasing that validation. And as a general life advice, chasing validation over substance is not always the road to lasting fulfillment. It can, of course, backfire greatly. And so now you have those employees, these top talents from other big name companies who joined the unicorn. And what type of offer do they typically get? They get an offer like, here is, I can only pay you 80% or 70%, 60% of your salary expectations, but I give you shares. And because you're part of this hyper successful company, that means something, right? You're now a partial owner. And that hits specifically hard for early employees who have been with the company in the seed stage and the Series A stage. And they have been working for very low pay, probably didn't get a salary raise at all over all of those years because they were told, oh yeah, but you have shares, right? It's just the way it is. Like, you have shares that you will cash out once the company is successful. And they believe that. And they work on their public holidays. They diminish their personal hobbies, their personal interests. They leave their families behind. They sacrifice family events. They stay in the office until 9, 10 p.m. each day. And they just hope that one day that will lead to the big payday for them, right? They all heard the stories of Microsoft, of other companies, how early employees were richly rewarded because they had shares. But the problem is that payday will never come, especially not after a unicorn valuation. That is probably the 0.001% of companies that can still turn it around after unicorn valuation. The payday will never come. And those employees, actually, in terms of liquidation preferences, at the bottom of the food chain. The moment the unicorn valuation took place, the late stage investors, had put down a lot of money to be a part of this, to become shareholders. They now have the liquidation preference. That means whatever happens next, their money will be secured. They will get their money back first.